Right, A Bala joins us now from Birla Sun Life AMC. Let's take a conversation forward. Bala, fantastic to have you back on ET now. Thank you for joining us. Bala, May has been a month of surprise. Terrible news on the medical front, but for an investor, in the month of May, the returns have been more than satisfactory. Why do you think this market is not reacting to what is happening on the economy? Yes, markets are forward-looking, but in this case, are they getting complacent?
Nikunj, good to be part of the show today morning. I think the way market looks at is, while it's no doubt in the last 1 month, the sudden lockdown which came from various states, at the same time, the steps that has been taken by the government and proactively in address some of these issues. And second is the Ministry of Finance again came with these kind of measures just to ensure that the economic growth doesn't get impacted, the lending activities doesn't get impacted to the needy sectors. And they came with the measures a little ahead of even the market, representing such kind of issues to the government. And then post that you take actions. I think on the basis of this, clearly the market still looks at the way forward that the pent-up demand, the economic growth would come back. Given the fact that one side, vaccination drive has been going very, very fast. Another say, number of cases which I think are getting reported for a brief period, about 2-3 weeks across various states, have started coming down quite significantly. There is significant improvement, they are saying. So therefore, it clearly gives a signal that while month of April was relatively unexpected by anyone actually of in any standards, but having done that, clearly the steps that has been taken by the government in various in variety of manners, I think now brings back the confidence. At the same time, the repeated message that has been coming from the regulators globally, despite the inflation being some bit of uncertain zone, at the same time, the Fed governors as well as the central bankers have reiterated multiple number of times that the low interest rate regime will continue till such time we see a decisive trend coming back on the growth path. I think it's more of confidence that being given by the system as a whole, and also an expected pent-up demand once it come back, the economy come back to normalcy. Then pent-up demand could also come back, as we saw last year on the month of July, which was a temporary July, August, September. We saw it was significant pickup. A similar trend after now, this time if it comes, probably it could have a long-lasting in nature. So that's where the market is looking at. And that's why if you see the breadth of the market has been increasing as a result of that.
Bala, but the difference between the first wave and the second wave is the intensity, the impact, number of lives lost, and what it could do in terms of the rural population. How come markets are not noticing that?
So I think while it is definitely the second wave much worse than the first wave, there's absolutely no doubt on that. I think this is the first time I think is now the economic activities and this I think is getting disconnected in the sense that when it was completely in the first wave, there are many things that are unknown. I think people are not knowing how to react, either for the policy making point of view or from the economic revival point of view, even from a consumer demand point of view. Then this time if you see while the number of incidences that has been reported is quite high, at the same time number of people have actually understood the seriousness of the whole matter and then respecting the lockdown more seriously. And that's something again is I think goes to go in terms of showing the understanding of the broad citizens in the country. At the same time, from economic activities point of view, it's not actually come in the way of derailing so much, given the fact that the last 1 year things got a little adjusted as to how parallel the economy has to run. And that's something in my belief is something is working quite well. Even the rural economy, except a few parts of the country, the rural economy again is not driven only by the fear and the other stuff. Is also of course the large economy is coming from Agri economy as you see today. The next crop I think will start the ahead of the monsoon season. I think agriculture economy has to get prepared for the forthcoming monsoon season having an impact on agriculture in terms of growing the crop for the next. That business of course goes on as usual despite even rural economy getting impacted. And second is the government initiatives towards pumping in money in the hands of people in the rural economy, whether it is giving the form of fertilizer subsidy and other things, also has its own impact to ensure that people don't suffer at the end of the day not having money. And that's something also in my belief is helping largely to keep the economy afloat. I think as things starts coming back and also at the end of the day, the large pool of savings, as you've seen in the US, I think savings rates has gone up quite substantially. Maybe the money in the bank account would be relatively higher compared to what you would have seen the 1 year back. So therefore, that also would come ultimately find its way to the spending habit changing or coming back rather. So therefore, these are some of the things which I think my belief is driving. And given the fact that if you see the GST collection which has been growing continuously, probably I would say the trades and commerce are not getting impacted given the fact the way the operation methodologies are also undergoing a change.
Sure. Bala, let's talk about financials, given how it continues to be the main area of focus. We were earlier this morning talking about the financialization theme, the broader theme, for India as an economy, but also as we see with the recovery, what is the kind of interest or opportunity you see across some of those names, and how are you really dissecting where perhaps the maximum opportunity lies within the space?
So I think if you look at the financial service industries, the way some of these big banks have been reporting their numbers, clearly I think the knee-jerk reaction that they would have had post-pandemic hitting the whole country and the world, and everyone has gone very conservative in terms of making their provisions a little ahead of time. And also the extended period of time which was given for the form of moratorium, definitely as this time has made people actually to look at repaying as and when they get money, rather than actually looking at defaulting. I think this whole mindset, given the moratorium given by the government, has I think changed the whole mindset of the people. Paying, I think, is more the intention rather than taking advantage of the moratorium, therefore don't pay. I think that change, I think definitely if you look at the numbers that has been reported by the lead banks in the country in the last few weeks, definitely reflects that the issues that are relating to the NPA provisioning is coming down. On the contrary, some of the resolution that has happened in the last few years also is coming and actually helping them in terms of writing back. And then third is actually given the fact that the pandemic had made a lot of people get worried, most of the banks are well capitalized, therefore no need to fear about, there is no capital actually in case the lending growth comes back. So I think the balance sheets of most of the banks have become much, much stronger. At the same time, the NPA levels are not as high as what generally people worry about it. I think broadly, I think the financial system actually today is much stronger than what you would have seen in the past. And that something is coming in the way of giving some kind of booster that as things get better, as the credit scores are coming back, and then most of them are actually well prepared actually to meet the credit demand growth that will come back. The fact of the matter is credit demand growth is not coming back, given the fact that most of the companies are still not so much aggressive in terms of building capex. The consumers are still not so much aggressive in terms of borrowing and investing. And since the time we see that coming in, financial system in general would remain more resilient and robust, I would say.
Okay, and what about discretionary demand, Bala, just to get a sense of really where you feel the economy is headed, in terms of demand, in terms of, consumer sentiment, how some of this will play out as well, because as you said, the second wave has been worse, and this time we have seen a bit more of an impact when it comes to spending and eating into savings.
I think clearly, if you look at the month of May was, of course, definitely for the end of April and month of May, a little worse than the previous months. There's absolutely no doubt. At the same time, it's obvious to understand that a strict lockdown in some sense comes in. Definitely from a consumer point of view, some bit of worry will of course come in or maybe postpone the spending. But one thing that has happened in the last 1.5 years is a worldwide phenomena, probably along with the high liquidity, along with the lockdown work from home kind of model, has definitely increased at the middle class population side. It has increased the savings in their account, which eventually will have to come to the market for increasing the consumption, rather, I would say, whether it is with respect to the travel or with respect to the spending on whether household items or maybe refreshing on the house that actually started happening quite aggressively during the second half of last financial year. All such things I would see it returning and rather coming back. And that's why I see it, is we saw it, even the two-wheeler sales suddenly is picked up quite nicely for about 4 or 5 months. So I would assume the current wave definitely probably would have held back people not to spend money. But at the same time, it's not coming at the cost of savings going down. Therefore, it's going to have an impact. I would assume the consumer sentiment would come back once things get normalized, maybe in the next 3-4 months time frame.
In the meantime, let me just take stock of what the market is up to. We're holding 0.5% higher right now, 67 points pushing forward, and 102 F&O stocks standing to the advances as we speak. Besides consumption and banks, Bala, what one is seeing is that metals clearly are the ones which have pushed the market forward from the last peak back in February up until now. Having said that, off late, one is seeing the street is getting a little circumspect on how sustainable this rally or move in metals is, given that it's been very steep and very sharp a move and a one-way move at that. Where do you stand when it comes to metals? And would you say that in terms of investment, there is still headroom going further, or would you say that the best is already behind us?
So I think looks like structurally the commodity cycles seems to be coming back. One on the back of the significant progress that most of the global economy has made, especially China, in terms of cutting down supply on one side, and then the whole demand also is contracted. Therefore, the whole supply-demand equation became neutral. At the same time, it also brought in price stability from the producers' point of view. The way, if you go by the measurement of iron ore prices, the way it has gone up, or the way the steel prices have gone up daily, I think all of them indicating some bit of industrial activities coming back. While the rise has been quite sharp, given the fact that led by Chinese demand going up, and also the post-US announcing almost about $6 trillion second dose of stimulus when they gave, clearly that boosted actually the confidence in terms of industrial activities coming back. Even now, globally, there is one expectation that is now setting in. The next few years, we'll see the capital sectors coming back, given the fact that most of the economies are now going to spend big time money in building the infrastructure and maybe spend money on various infrastructure needs. If that is going to be the case, probably we'll see the metal as an industry would probably see longer term, we'll see probably some kind of cyclical correction, given the fact it has gone up quite a lot. But I think it appears to me that probably we'll see a bit of long run momentum to stay positive for the metal asset sectors, given the fact that industrial activity also gradually is coming back. I think the biggest spender, as we all know, I think the various governments and various across different parts of the world have become very aggressive in terms of spending towards infrastructure. Unlike the first lockdown, it was more of motto to give money in the hands of people. But the second lockdown seems to be making people realize that spending money on economic recovery is the most critical, and that something is coming. Also, I am told there are a lot of demand coming for some of the metals coming from electric vehicles and other various industrial activities. So all such things, I think, should keep it more sustainable in the long run. It may go through, given the nature of this sector, it may go through some short-term volatility, which is bound to be there, having seen a significant rise in the last few months.
Sure. Also, Bala, I wanted to understand where is it that you stand when it comes to, this entire agri commodity theme. I know we just touched upon metals, but what's happening is agri commodities is perhaps far greater than what is turning out in metals as well. Be it sugar, coffee, tea. All of them are also soaring one way upwards. Would you say that at large, commodities are currently in a super cycle, which is going to stand for, many months to come?
So I feel, of course, it's very difficult to make comment on the agriculture, given the fact that the sensitivity that has got attached to the one for inflation, And second is the farm producers. I think both have to get balanced very appropriately. And therefore, the intervention of the government in various parts of the time, subsidizing some of them in the interest of controlling inflation as well as controlling from the consumer demand point of view. Clearly, the way even the Indian government has been functioning for the last few years, increasing the farm income in the hands of agriculturists, definitely the various steps is being taken, including the price rise, would have some impact from the producers' point of view. At the end of the day, Agri being commodities need to have the right balance between the price rise as well as consumer demand. The kind of bull run that we are seeing in the metal and other commodity prices probably cannot happen in this segment in a sustainable manner. It may see a temporary one crop getting affected, therefore the price shoots up. Such kind of thing could happen. And unless we see a continuous drought kind of situation in the commodities, agri-commodity space, probably we cannot expect the price to remain too high for too long period of time. What we are saying is definitely is temporary. The case of sugar, definitely especially in Indian case, with ethanol being one of the things that being now encouraged by sugar manufacturing companies to even use it for the other purposes, given the fact the oil prices have been rising. Therefore, they get a better realization on that space. And third is even the power sector, that they also make huge investments. Given the fact that power sector has gone through a consolidation, any better realization coming from this segment also would have some bit of positive impact on some of these companies. At the end of the day, given the fact sensitivity attached to that from inflation point of view, how much government allow would prices to go up would always remain a big question mark.
All right, Bala, we've been asking all our experts their advice on how to get rich. Do leave us with some nuggets of wisdom today.
Thank you.
Bala, your strategies for investors who are looking to get rich, what would be some of the investment advice that you could share with them?
Yeah, sure. I think clearly, I think rich is the function of how you want to define yourself rich, because rich is something extremely difficult to define. At the same time, from a common investor's point of view, definitely investing in the market through the mutual fund, especially the economy is actually going to come back, and also given the fact that interest rates are is going to stay low for a considerable period of time, the best way actually to invest through the mutual fund is good mix of the funds that focus on multi-cap kind of categories or small and mid-cap kind of category, as long as he has a time period of more than 5 to 10 years kind of period. So I think rich is the something depending upon how he wants to feel satisfied that yes, I have earned more than what I have. In order to make that happen, make his money to work, investing at a continuous basis through the mutual fund is something is the best model to which he can do. The other advantage in the investing in stock market, all of us should remember that we will go through a volatility in the individual stock that we make investment, and our portfolios are generally, when we invest in market, we never constructed a diversified nature. We invest in one stock, two stocks, we'll go through volatility. When it comes to the mutual fund, definitely it gives a diversified portfolio, takes away the worry of too much concentration. At the same time, helps you build very strong portfolio for the longer term investing as a concept. So that's why I would encourage being part of the mutual fund for some number of years, having some multiple cycles. I would say the best way to make your investment work for you through the mutual fund model.
Great. Bala, thank you so much for joining us this morning. Great speaking with you as always.